Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 10, the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And before I go on to the problem, the thought just occurred to me as I was reading that that when it does come to this idea of stock, and at least for me, uh, I can read about the concept, okay, but the application aspect of it seems to more solidify the concepts themselves, okay. So just be aware that as you're reading the chapter, and even if you watch my videos, the theory can be sort of nebulous. Like, for example, I say preferred is very much exactly the same as common, right? But then when we have dividends, it all depends, okay? And I can explain cumulative and non-cumulative, but um, when you see the application aspect of it, it sort of more solidifies that theory and that concept so that you understand why it is what it is. And the reason why that popped into my head is because as we go through these short exercises, they're becoming, each one is becoming more difficult than the other. Not so much in difficulty, but the level of difficulty is because of the increase of the theory in and of itself. Okay, and you'll see that as we take a look at the common and preferred stock for this particular exercise. So it says here stock issuance, right? So it has two classes of stock, $15 par common and $25 per par preferred. So we have common at 15 and preferred at 25. So issuance, journalized issuance of the following: 1,000 shares of common for 35. Okay, so we're issuing $35 a share, and the par is 15, so that's like an additional $20 over and above par. Okay, but that's just looking at it from the aspect of the price of the stock. All right, at par and issuance, and the paid in capital in excess of par, but that's thinking of it from the terms of price. When we were taking 1,000 shares at $35 a share, that means we're getting $35,000 in cash. Okay, so we're going to debit our cash for the $35,000. Okay, and since 1,000 shares, right, at $15 a share is 15,000, right, we're going to credit our common stock for 15,000. And then, of course, you could do it one of two ways here. I can say, okay, since I figured out what my excess of par is, being $20, I could take 1,000 times the 20 and get $20,000 as my paid in capital in excess of par. Or I can sit down and simply go, I credit my paid in capital in excess of par. And to figure that out, I could just back into the number. Why? Because debits have to equal credits, right? So if I have a debit of 35 and a credit of 15, my debits have to equal credits, so I can back into that number of $20,000. Okay, I could have figured it out, right? Here's my cash, here's my par, here's my paid in capital, right? Or I could have figured out my cash, figured out my par, and then just backed into the paid in capital, right? So that's the common stock, and preferred is basically the same, right? There's, for this problem, there is not much of a difference. Okay, we have 2,000 shares of preferred for a total of $83,000. Okay, so I'm going to receive cash for $83,000, and I'm going to credit my preferred stock. Okay, I have 2,000 shares at $25 in par, or 50,000. Okay, and again, which method am I going to use? I like using the backing into method, paid in capital. My debits equal my credits. Well, the difference between these two is 33,000, and that's it for making that journal entry. So you can see, I mean, by using this method, you're not being told what the price is of the stock when you're when you're selling it. You're being told the dollar amount. Now, can I figure that price out? Sure, I can. All right. If I have 83,000 and I divide it by 2,000, that's not right. Let me think about this just for one quick second. Yeah, 83 divided by 2,000 shares. Yeah, I end up with $41.50 per share. Okay, that's how I can figure out the dollar price of the preferred stock, the market price. And again, here's an example of here's the totality of the concept, and I can figure out the bits and pieces as I need them. But notice it was just a lot easier for me to go and do it this way, to just back into the paid in capital. All right. Now, if I was asked what the dollar amount is, all right, well then, yeah, I'd have to figure it out, and I have all the information here. And you saw me just do that. 83,000 divided by the 2,000 shares gives me 41.50, if that's what I was being asked. Right. Okay, enough of that. Next one. All right, so it says here, accounting for cash dividends. All right, so we're stepping up a little bit here. All right, so Watkins Enterprises earned net income of $95,000. Excuse me, during the year ended December 31st, 2014. On December 15th, 2014, Watkins Enterprises declared the annual cash dividend of its 2% preferred stock, total par value of $140,000 and $70.70 per share cash dividend on its common stock, with 80,000 shares outstanding. Watkins then paid the dividends on January 4th. Okay, so if you recall from in the textbook, let me just flip open to the page so that I don't get the naming wrong. Sorry about this. You have your declaration date. Okay, so our declaration date here is December 15th, right? This is the day where they're declaring the cash dividend. So 12/15/2014, right? Then you have a date of record, which we're not being given here, okay? The date of record says whoever owns the stock on that date will get paid that dividend that's being declared on December 15th. And then you have the payment date. In this case here, it's January 4th, 2015. All right, and in between, we have here the December 31st, 2014, which is our year end. Right. So just be aware what we're looking at from a timeline perspective here. We have a declaration date, then we have the date of record. Anybody who has stock at that point in time gets paid how much the dividend is. We have to still figure out how much that dividend is, right? So we don't know how much the dividend is. We're going to have to calculate that. And then we're at the year end, and at the year end, we have to make an entry because it's an accrual, right? It's not something that we have paid out yet because we're not paying it out until the next year on January 4th. So we need to make some kind of entry here for the year end. All right. So let's go through what we need to go through here. All right. So it says here, I don't like that. That wasn't good. Cancel, cancel. Oh, apologize for technology. Let me pop this back open. All right. Let's see if I can't. All right, close that. Sorry about this. All right, there we go. I can't speak for technology sometimes, and we were working on 7 here, right? Okay, sorry about that. Yeah, it's just technology, and I decided I'm not going to go over another 12 minutes, redo the 12 minutes of video. So it says here, journalize for Watkins declaring the cash dividend on December 15th. Okay, so when we declare the cash dividend, we're going to have to calculate how much it is, right? And we have preferred stock, 2% of the preferred at 140,000. Right, so for our preferred, oops, let me get my fingers working. So I have preferred here. We have total par value of 140,000, right? And we're getting 2% on the 140,000, right? So that comes out to $2,800 is going to go towards preferred. For common, we have 80,000 shares outstanding, and they're getting 70 cents, right? So 80,000 times 70 cents is $56,000. Okay, so the total of the dividend is going to be the 2,800 plus the 56,000. So 56,000 plus 2,800 is 58,800. That's how much our dividend is going to be. Right. So now to make that entry, right? Where does the dividend come from? All right. Well, in the theory videos and in the last video on that exercise, I explained that dividends come out of retained earnings, right? And we know that when we're going to make this journal entry, we know that the normal balance of retained earnings, the normal balance is a credit, right? Meaning, we take our profit or loss, and when we close it out to retained earnings, hopefully we have a profit, and if our profit is our profit is a credit, we close it out, we increase the retained earnings on the credit side, because the normal balance of retained earnings is a credit. Assets is equal to liabilities plus equity. Assets are a debit, liabilities are a credit, equity is a credit, right? When we increase our equity, we're increasing it on the credit side, so we increase our retained earnings on the credit side. Now, the reason why I went through all of that, which is something you learned back in chapters 1, 2, and 3, is because we're paying the dividend here, okay? Well, if we know that we're taking out of retained earnings, we need to debit our retained earnings to decrease it, right? Because the normal balance increases on the credit side, right? So we're going to debit our retained earnings for the 58.8, and we'll credit. Now, what are we going to credit? Well, this is something that we're going to owe. Remember, we're talking about this being on December 15th is the date that we declare it, okay? And we're making this journal entry at the end of the year end on December 31st, right? We haven't paid it out yet, so it's something we owe. So we're going to credit dividends payable for the 58.8. All right. Now that entry is made on 12/15 because this is the day. Excuse me. This is the day that we are declaring the dividend. Okay. Now, when it comes time to pay it out on January 4th, right? January 4th, 2015. It's 2014. Right? Well, when we pay it out, what are we going to do? Well, we're paying out cash, so we credit our cash for the 58.8, and we debit. What do we debit? Well, our dividends payable, right? For the 58.8, right? And that's that journal entry. Why? Because we're crediting dividend, debiting dividend payable for the same amount, so that those two amounts wash each other out, and it's as if we paid out in cash our retained earnings. Same kind of thinking behind accounts receivable and accounts payable. If you watched the last video, the previous, for the last exercise, you'll see my explanation of that. Okay. So that's it for this exercise, and if you didn't follow that, like I said, kind of like watch the last video, the theory behind what's going on here, applies. I explained it in the last video and applies right here. So watch the two in conjunction. All right. And if you still have any questions, feel free to contact an instructor, and I'll see you in the next video for the next exercise.